Thank you very much, and very good to be here in Oslo. I've got 10 minutes. We're all under pressure here, especially as I'm the warm-up for the Prime Minister, so I've never done that before, so that is real pressure. So in 10 minutes, rather than go through all the slides that I've got here, I'm really going to try and get you to think about some fundamental aspects of renewable energy compared with fossil fuel energy, because I think one of the biggest barriers to the acceleration of the energy transition is not so much an economic barrier, because the economics now are increasingly irresistibly in favor of renewables. The barriers are psychological, and I'll explain what I mean by that, and then I'll go through a few of the slides and finish with some comments on a recent research report I wrote looking at the economics of oil versus renewables and showing how absolutely superior the economics of renewables to oil are, even in the field of road transportation. But if you think about renewables versus fossil fuels, we all know that renewables have tremendous environmental benefits compared with oil. But forget those. Let's just focus on the economics. What are the fundamental differences in economic terms between renewables and fossil fuels? I think the fundamental difference, and this is why it's so difficult to really understand it, particularly for the people who are running the fossil fuel industry, is that, because it goes against 250 years of economic thinking, is that renewables by their very nature are deflationary, and fossil fuels by their very nature are inflationary. Okay, now what do I mean by that? I mean, if you think about, let's focus on the oil industry. If you think about the oil industry, most of the returns, or the highest returns available in the oil industry, are upstream, right? That's where the risk is. That's where you have to go out and explore for and produce energy, often in very challenging environmental and geological conditions. If you're going to take those kinds of risks, investors require high returns for those risks. So typically, you look at the upstream oil industry, you're getting returns of 15 to 20%. Not every time, of course, but that's the whole point. You're taking a big equity risk. That's why the oil industry is typically very heavily financed by equity and not by debt. Okay, so upstream is where the action is if you're a fossil fuel investor. If you look at the renewable energy industry, the first thing you notice is there is no upstream. There's no upstream. It's just midstream and downstream. It's just infrastructure. It's not even energy. You don't have to go out and explore for energy. You don't have to produce energy. You just need infrastructure to capture energy when it's available. And when it is available, it comes for free. So it has a zero short-run marginal cost. Now, if all of the cost for renewable energy, or most of the cost, is in the infrastructure, and the cost of that infrastructure has been declining, it's been dropping like a stone, in fact, for the last 10 years, that tells you that this is an inherently deflationary industry. Whereas if you look at the fossil fuel industry, the oil industry, you begin by going for the resources that are easiest to exploit. They're the cheapest to get. And over the last 120 years, as the oil industry has advanced, we've developed these tremendously complicated and expensive ways of extracting oil. You can go offshore Brazil, 500, 1,000 miles off the coast of Brazil, and drill beneath the salt deposits in the sea and get oil from down there. That's a very complicated, very expensive thing to do, and over time, you're forced to do that. You're forced to keep going up the cost curve. 15 to 20% average returns upstream, I mentioned, versus 6 to 8% in renewable energy. Your average oil executive is going to say, why am I going to invest in renewable energy if I can only get 6 to 8% return when I can invest upstream and get 15 to 20%? And the answer is, in the future, you won't be able to get 15 to 20% because you now have a competitor that's cleaner, easier to transport, and much, much cheaper. So that's why I say the barrier is often psychological. The oil industry, I was a power analyst for 20 years. I have seen a well-established, deeply capitalized, very strongly entrenched politically industry, the European power industry, lose half of its value in the last 10 years, 50% of its value. When I was at university, they taught me that utilities was studying finance, utilities are meant to be a risk-free, or as close to risk-free as you can get investing in industry. Well, you'd have lost 50% of your investment if that doesn't sound very risk-free to me. And what's happened to the European power industry is what is about to happen to the oil and gas industry over the next 10 years if they don't get their act together. That's the challenge we're facing. The economics have become indisputable. I'll skip through this. It's just to say that we at BNP Paribas have been a very pioneering company, asset manager in terms of sustainability. We're part of this Climate Action 100 Plus initiative, which is a group of institutional investors, $33 trillion of assets under management, and we are pushing the largest emitters in the world to align their business models with the Paris Agreement. And we've already chalked up some successes. When investors group together, you can really have a powerful voice at the table, and you can get CEOs to start moving the needle. But we're still up against this psychological barrier of companies thinking they can make more money. It's a bit like what the two previous speakers were saying, Hong and Kevin. The opportunities are there, and if they're not being grasped, it's because so often the incumbent industries are stuck in a different paradigm. But the paradigm is broken, and they need to understand that. Thermal coal. We at BNP Paribas are, from January next year, are divesting from coal. We will no longer be investing in coal. Two reasons for that. One, thank you very much. Two main reasons for that. One, we have a public commitment to align all of our portfolios with the Paris Agreement by 2025, and getting rid of coal is the first step towards doing that. We're not going to stop there. We're going to look at all the other carbon-intensive industries, and we're going to progressively look at the how closely they can align with the Paris Agreement. But secondly, it's an economic decision. Coal is now, forgive the looseness of my language, but it's a lousy investment. Why would you invest in coal today? I mean, people often say about fossil fuels, we're going to need them for many decades to come. I'm speaking purely as an investor. That may or may not be the case, but even if they're still producing, they won't be making any money. If you look at the German power industry now, they're still producing a lot of electricity from coal. It's not making money. It's at the margin. It's been priced out. So this is for any investor, I think, now, a pretty clear and easy decision. Particularly in developed markets. So there is stranded asset risk, there is climate and reputational risk, increasing societal concern. There's an entire feedback loop here of factors that are pressurizing coal, and after coal, the other fossil fuels will come into the equation. I won't go through this. You all know that coal is the most important driver of climate change. What I will say is that we've already got between 150 and 250 billion euros worth of stranded assets in coal-fired power generation in Europe. And the reason for that is quite simple. As I said earlier, you've got a source of energy now on the German and European power system, renewable energy, that has completely revolutionized the economics of this industry and undermined the profitability of traditional established industries. I want to conclude. So basically what we have is we're aligning, the way I say we're aligning our portfolios, we've taken the International Energy Agency's sustainable development scenario that says that power generation globally must get its carbon intensity down to 327 grams of CO2 per kilowatt hour by 2025, and that's the trajectory we are following. So any power generation company that is not in line with this trajectory will no longer be in our portfolios from January next year, so in a couple of months. I want to conclude with a couple of comments, since we're in Norway, and Norway has a lot of oil. I want to conclude with some comments about a report I published 3 months ago. It's called Wells, Wires and Wheels, with a subtitle of Iroki and the Tough Road Ahead for Oil. Iroki stands for Energy Return on Capital Investment. And what I did, I said, if I have $100 billion to spend, and I can spend that money either on oil or on renewable energy, and I want that energy for road transportation, don't forget, road transportation is 50% of global oil demand. So I want to get as much energy as possible for that $100 billion investment. And what I found was, at the current oil price of $60 a barrel, than taking new build costs for offshore wind, solar, and onshore wind. When you go through the entire value chain and you take account of all the costs you have to cover to get the energy from the source of production to the end consumer and all the energy losses that occur along the value chain, you would get, at today's costs of new build, without taking into account the externalities, you would get 6 to 7 times more useful energy, i.e., energy that actually provides mobility, energy at the wheels, let's say, 6 to 7 times more useful energy, spending that 100 billion on new renewable energy, using the electricity for electric vehicles, than you would investing that money in oil and converting it into gasoline and burning it in a combustion engine, and you would get 3 to 4 times as much energy as you would converting it into diesel. Flip that round, what's the conclusion? The conclusion is, on a medium to long-term view, i.e. 10 to 15 years, the oil price will have to go down to $10 or $20 a barrel for gasoline and diesel to remain competitive as sources of fuel for road transportation. 50% of global oil demand, in other words, within 10 to 15 years, will be redundant because the speed with which the technology is changing, the speed with which the auto manufacturers are betting the future on electric vehicles, means that oil simply will not be able to compete within 10 to 15 years with renewable energy in tandem with electric vehicles. So the message is, renewables are here to stay. They will only get cheaper. Fossil fuels will only get more expensive. It's a no-brainer in terms of how society should be moving and how investors should be moving. Thank you very much.